What is PMI? PMI stands for Private Mortgage Insurance, which is insurance that you, the home buyer, pays for to protect the lender in case you go into default or foreclosure, sort of like risk insurance. So it's insurance you pay for, but unfortunately protects somebody else. The nice thing is it helps you to buy a house with less than a 20% down payment. So if you're taking out a conventional mortgage with a 5 to 10 to 15% down payment, all lenders will require you to pay this PMI. FHA loans, USDA loans have similar insurance costs, but that insurance is issued by the government and can be called different things as opposed to being issued by a private mortgage insurance company. The cost for PMI will vary from buyer to buyer because the loan parameters are different. The primary factors determining the cost of PMI are, number one, your credit score. The higher the score, the lower the cost. Number two, your down payment, typically in 5% increments. Put 5% down, 10% down, 15% down. The more you put down, the lower the cost in those 5% increments. So higher scores, more down payment, lower PMI costs. There's three primary ways to pay for private mortgage insurance. Number one, you can build it right into your monthly payment. So you pay a premium each month in your payment, takes care of your PMI. Number two, you can also pay for what's called a single file premium. A single file premium is a lump sum payment at closing in exchange for no PMI in your monthly payment. So you can pay more at closing in exchange for a lower payment, or pay PMI in your monthly payment where you pay more in the payment but less at closing. Pay me now or pay me later. There's also a blended premium where you pay a little bit at closing in exchange for a slightly lower payment. The key here is you have choices, and you have to work with a good mortgage banker that can explain the pros and cons of each option to you. You want options. And as with all financial decisions, there's always pros and cons. You just have to pick what's best for you. PMI can also be dropped once your loan value reaches 78% of your original purchase price or 78% of a new appraised value after a couple of years. So in that case, you would have to get a new appraisal and check the amount of equity in your property. It's very important. Talk to your servicer before you do anything, because they'll have the guidelines for you. And each lender might be slightly different. With USDA and FHA loans, you'll pay the mortgage insurance cost for the life of the loan. Here's the last part I want to talk about, and this is important for you home buyers. There's 5 major PMI companies out there. MGIC is the biggest of them, but there's 5 companies because they're all different. They all have slightly different guidelines and how they underwrite and approve and issue insurance. And also important, they all have different cost structures. Now, on some products, there's not a big variance, but sometimes there can be a big spread in cost. So as a home buyer, here's what's important to you. Number one, you want options on how to pay your PMI in the payment, single file premium, blended premium, and you also want access to the different mortgage insurance companies. And you don't buy it, but you have a say, okay? The lender will buy it for you. Some lenders do not have access to all of the major insurance companies. Some lenders have no choice at all because they're selling the loan, they're giving the loan, they're brokering the loan up front to an investor, and the investor chooses for you. So my recommendation to all home buyers, work with a really good mortgage banking firm that can show you the differences of the payments and how to pay it and what's going to be best for you, and has access to all the different major companies to get you the best terms on the insurance. Hope that helps you out with understanding what is PMI.